to our viewers. This is Vishal Goenka, co-founder at IndiaBonds. It's always been our effort to connect bond investors with the top corporate India. And very excited to host Piramal Enterprises, Mr. Jairam Sridharan today to talk about the key milestones of the group and the way forward. Piramal is a household name, very well understood. Little background about Mr. Sridharan. He's the CEO of Retail Lending, MD of Piramal Finance Limited, and over 2 decades of rich domain expertise. Prior to Piramal, Mr. Jairam was the CFO at Axis Bank. He's handled a variety of roles at the bank, including being President, Retail Lending and Payments. And in the 5 years that he was here, Axis Bank saw a 6x growth and emerged as one of the top retail lending institutions in the country. Before Axis Bank, Mr. Jairam served at Capital One Financial, a consumer bank based in Richmond in the US, and as head of new to credit card acquisitions in the US. He holds a Bachelor of Technology degree in Chemical Engineering from IIT Delhi, a PGDM from IIM Kolkata, where he was awarded a Roll of Honor for academic excellence. He's been awarded a lot of recognitions, Financial Express Pillar of BFSI industry in 2022. In 2019, Institutional Investor magazine named Jairam Best CFO in their All Asia executive team, and also ET Award of 40 Under 40 as the hottest business leaders. So without much further ado, it's really a pleasure to host you, Mr. Jairam. Piramal Enterprise and Capital Finance have seen various journeys, and we would love our bond investors would love to hear more from you. Over to you, sir.
Thank you, Vishal. Thanks for having me. And thank you to all bond investors who have joined this call, who are listening to this on the digital media. Thanks for your time. I will take a few minutes to walk through the story of the transformation that has happened over the last few years in Piramal's financial services business. And after maybe 20-25 minutes of that, maybe we'll open it up to the group for any questions that you might have.
Yes, just a reminder, viewers, sorry, you can type your Q&A in the chat section. We will address that at the end of the presentation.
Perfect. Thank you, Vishal. Let's jump in. If you could go to the next slide, please. Yeah, and move ahead. We'll talk a little bit about the corporate overview first, and then I'll talk about individual businesses, then talk about risk and profitability, talk a little bit about our liabilities strategy, and then conclude. If you start with the corporate overview on the next page, yeah. All right, so this is the big picture story of Piramal Finance that I'd like to share with the group, which is number one, that it's a strong promoter group with a demonstrated ability to raise equity and debt. We have a strong management team, which I'll try and showcase a little bit. I'll talk a bit about the transformation process, which is point number 3. We have been going through a transformation process for the last few years, and I've made the argument that we are done with the transformation, and we've been able to successfully close out all the things that we had promised a few years ago, and the turnaround has fully been achieved. The retail business, which we started new in 2020, is now 80% of our total AUM. We'll talk a little bit about that. Profitability, which has sometimes been volatile as we've gone through a transformation journey, has fully stabilized. Again, I'll show some information and data on that. And finally, we'll talk a little bit about balance sheet and how the balance sheet is really strong in terms of both capital adequacy as well as liquidity. So that's the story and the narrative that I want to share with you all. If you could go ahead and jump in. So first, this is about the group. As Vishal mentioned, many of you might be familiar with the group already, but just to give a real quick sense, Mr. Raja Piramal, the chairman of the group, there are 2 major companies in the group, financial services and pharma. Financial services is listed as Piramal Enterprises Limited, and the pharma business is listed as Piramal Pharma Limited. The promoters own about 46% in financial services and 35% in pharma. There's also a real estate business, but it's relatively small and it's privately held. It's not a listed company. So there are 2 independent listed companies, one in the financial services side, one in the pharma side. The team that you're speaking with today represents the left-hand column, the financial services column. So financial services, including the top co, which is the listed entity Piramal Enterprises, and the bottom co, which is Piramal Finance, which is an NBFC, which is where all the business is actually housed, or 80-90% of the business is actually housed. Piramal Finance is an upper layer NBFC. Just to give you a sense of what that means, there are 10,000 NBFCs in the country, roughly, and of that, the 12 largest private NBFCs, so the top 0.1% of the NBFC world, the top 12 NBFCs out of 10,000 are tagged by RBI as upper layer NBFCs, and hence are governed by RBI much more closer, and in a way which is very similar to the way they govern banks. Piramal Finance, which is the bottom co here, is an upper layer NBFC, and hence goes through that level of scrutiny from the regulator. On the right, you also know that the group has been able to raise both equity and debt fairly steadily and has had market access really well. We last raised about $2 billion of equity around 2020 through various means. This was right in the wake of NBFC crisis. So you can imagine that right after crisis and in the middle of COVID, the company was able to raise $2 billion of equity relatively easily. And we also have strong coverage from a lender standpoint in terms of number of lenders, the variety of lenders, etc., and strategic partnerships with a lot of the biggest names in global financial services. So that's the group overview. I'll not go more into it. The group is well known, but just to raise these couple of important points. Let's move ahead. The board of the group actually is very distinguished, and it's a key differentiation of this NBFC compared to many other NBFCs that you would see. Typically, you would see NBFCs in India be very dominated by promoter families or kind of friends and family of the promoter group. Here you see a very, very professional board, 10, 11 independent directors, all of whom have very strong individual reputation, whether it's the former managing director of Axis Bank, Shikha Sharma, or Anjali, founder of Amana Capital, one of the largest, biggest VC names in the country, Kunal Bail from Snapdeal fame, Mr. Rajiv Mehrishi, former finance secretary of the government of India, Anita, the former head of CDPQ in India, Puneet, managing director of the Dalmia Group, and so on, and Ashit Mehta at the end, senior partner till very recently with McKinsey & Co. and head of their financial services practice globally. And of course, our expert council headed by Nitin Noria, who's our senior advisor, I should say Padma Shri Nitin Noria after what happened a couple of months ago, and former dean of the Harvard Business School. So extremely high profile, very, very accomplished people on the board. So that's a very distinguishing factor of Piramal compared to most other NBFCs that you would see. Moving ahead, from a management team standpoint, you heard my introduction before, and my colleagues, Ruben, Yash, Kalpesh, you can see on the page here that people have, the management team, the top leadership team has come from storied institutions, both academic institutions as well as workplaces. Very professional, have seen financial services for long periods of time. It's a very new look management team. All of us have joined. I joined in March 2020, and most of my colleagues here have joined after that. So it's a very new look management team, very different from what you have seen in the in financial services avatar of Piramal in the past. So the management team did get revamped around 2020 timeframe, and what you see here is the professionalization of the group and people with strong financial services expertise. Let's move ahead. I won't go into this in detail. A couple of big points that I've mentioned is that the company is about 13 years old in financial services. We started in wholesale financial services, doing developer financing. And did that for a while, but then as a company which only did developer financing, we got into a lot of trouble around 2019 because real estate market in India went through a lot of trouble, and we were 100% exposed to that part of the market. At that time, we diversified, we got into retail and started building a retail book. And to begin with, we also did a big acquisition, which is Diwan Housing, the affordable housing finance company, which we acquired in 2021. to date, the largest resolution under bankruptcy of any financial services company in India, and the most successful. We have built the retail business since then and have completely transformed ourselves from being a wholesale NBFC to being a retail NBFC. I will show some data going forward which talks about that. Let's move ahead. So this is our financial year 25. The AUM is 80,000 crores, which puts us in the top 10 largest NBFCs in the country, which is why, of course, we are an upper layer NBFC. We have a net worth of 27,000 crores, which puts us as number 3 in the country in terms of size of net worth of any NBFC. So you will also notice that net worth of 27,000 crores for an AUM of 81,000 crores. We are extremely heavily equitized. Very, very high levels of equity. The consolidated PAT of 5 crores in financial year 23 and financial year 24, the company had losses on a consolidated basis. That is because, as I will talk about later, we were resolving very large pockets of real estate lending, what we call the legacy book. And that came in with significant provisions. But we were able to take those provisions through the P&L. Our P&Ls were negative for 2 years. Last year, that turnaround got done. So we came back into positive of about 500 crores of profits. And I will talk in a moment about what we are expecting in the next year, etc. So after 2 years of losses, last year we turned into profits and continue to grow very rapidly from there on. And you will also notice that in spite of the big losses that I spoke about for 2 years, our net worth continues to be extremely high. 27,000 crores out of an 81,000 crore AUM. So those are the big points to take away here. If we could move ahead. This is the transformation story. You see the book was stable for a while because we were degrowing one part of the business, the legacy book, which is the top right. It degrew from 43,000 crores 3 years ago to about 7,000 crores now. So degrew at an extremely brisk pace of a CAGR of about 40%, 46% over 3 years. And while that was happening, the new book, the growth book, which is largely retail with a little bit of wholesale thrown in as well, that grew at a CAGR of 50%. So that one part was growing, one part was degrowing. Because of that, the total AUM remained stable for a couple of years and now really started growing. Last year, we grew our AUM by 17%. Retail, which was almost non-existent 5 years ago, is today 80% of the AUM of the company. And from almost no branches, we now have 517 branches, etc. So, and while this has been happening, we have also simplified our corporate structure. We demerged the pharma business into a separate listed company. We sold some of our non-core investments, particularly in the Shriram group of companies, and we also created a tax shield of carry forward losses of about 14,500 crores, which will help us in the future in terms of providing significant tax shields. So this is, in one page, the picture of the transformation that has happened in the company over the last 3 years. So when I say that we used to be a wholesale lending company and we have now transformed to becoming a retail lending company, that's what this shows. And it also shows that we have transformed from a profit profile perspective, going from a loss-making company for a couple of years while we were undergoing the transformation to actually becoming a profit-making company the last year. Moving ahead. This shows our promises that we had made to the investing public at the beginning of last year and how we did against that as the year progressed. We had said at the beginning of the year that we will grow our AUM by 15% to 80,000 crores. We actually grew by 17% and finished at 81,000 crores. We talked about a retail wholesale mix of 75-25. We did a little bit better than that. We entered at 80-20. We said that we will bring the legacy book, which was at the beginning of last year at 14,500 crores. We said we'll bring it down to 7,000 crores, 6 to 7,000 crores. We ended at 6,900. The AIF book, which is off book, we said we will create gains of about 1,700 crores over 2 years. We created 926 crores in the first year. And finally, very importantly, OPEX to AUM of the new business, we had said that we will end the year at 4.6%. We did significantly better than that and ended the year at 4%. So basically, we met all the big guidance that we had given for FY25. And in light of that, if we could move to the next page, here is the guidance that we have offered to the market for FY26. We are talking about growth in AUM versus 17% that we achieved this year. We are guiding the market to a 25% growth next year. And we should our AUM should cross 1 lakh crores. of which the new business, the growth business, will grow at about 30%, and retail will be roughly in the same range, 80 to 85%. The legacy book, which starts this year at just under 7,000 crores, we are guiding that it will halve again to become 3 to 3,500 crores by the end of the year. And consolidated PAT, as I said, 2 years of losses, then 500 crores of profits last year, and we are guiding that it will grow by almost 3x to 1,300 to 1,500 crores of profits in this year. So that's our guidance for FY26. Let's move ahead. So that is a big picture view. The rest of the sections I will drive through a lot more quickly, and I might not touch on many of the slides, but these give you a sense of where the various businesses are. Let's start with retail. You can see that the growth business overall is now 91% of the book. Let's move ahead. We spoke about this already. The retail business is 64,000 crores of AUM, present in 517 branches across 26 states. It's the core of this is a mortgage business, home loans and loan against property, which is 64 out of the 64,000, 44,000 is mortgages. And it has been growing at about 34% year on year, and AUM yield is about 13.5%. So we make a yield of 13.5% with a 90-day delinquency of 80 basis points and an OPEX to AUM of 4.3%. If you could move ahead. There are 2 or 3 slides here that I will talk about. The left-hand side here shows how diversification in the retail business has been growing. So 5 years ago, of course, we had no retail business. Then we did the Divan Housing transaction, which was entirely housing finance, and which is basically the dark blue box right at the bottom. So that used to be 100% of our book about 5 years ago. That has slowly reduced because we've built a lot of other businesses. While in absolute size it has been growing, but as a proportion it has come down from roughly 100% of our business to 40% of our business. And all the other stuff is new businesses that we have built over this period: loan against property, used car finance, business loans, personal loans, and digital lending in particular. Disbursements have been growing nicely, as you can see in the chart on the right. For 3 years, you can see that every curve looks significantly above the previous year's curve, and this year has started well as we speak. Let's move ahead. I won't go into this in a lot of detail. These are kind of details about individual products. The only thing that I point out is under the column of housing loans, if you go to the boxes at the very bottom, you will see some infographics about the business. And the important thing to note is the 4th box there, which is disbursement yield. So you will see that housing loans, which is about a 27,000 crore book for us, we do business there, and the disbursement yields there are about 11.5%. So it's not a typical bank type housing business. Banks today lend housing products at 9.5%. We lend at 11.5%. So it's a significantly higher price point than what you would expect at a bank or from a AAA rated NBFC. So we are at 11.5% in housing. We do LAP at almost 13% and used car financing at 15% yields. If you go to the next page, this shows the products on the unsecured side. We do salaried personal loans at about 18%. Business loans at 19%, and digital loans at 16%. And you can see that business loans and digital loans, we have actually reduced disbursements materially. So you can see the red arrows, and you can see how the orange line is below the blue line. So these are 2 businesses in which we have reduced disbursements, and you will see in a moment why that is the case. Let's move ahead. The wholesale business, the new wholesale business that we have been doing, we have an AUM of about 9,000 crores with a portfolio EIR, fees plus coupon of roughly 14.5%. This is in 2 parts. Real estate is roughly 70%, and mid-market lending, which is lending to other corporates which are smaller in size, is about 30%. And the average ticket size is very granular at about 70 crores. In our previous avatar, when we were doing developer financing business, we had ticket sizes which are about 500 crores. That number today is about 70 crores in terms of the ticket size of wholesale lending that we are doing, the new wholesale business. Let's move ahead. This shows the one thing I want to look at, or want you to look at, is the rightmost bars, which is the repayments. You can see that the repayments in the new wholesale business have been extremely high. For a business with an AUM of 9,000 crores, if you just see Q4, for example, we had 1,500 crores of repayments. So 1,500 crore repayment in a 9,000 crore book, 1,500 crores in 1 quarter. So that's a crazy high level of repayments. And that shows you how strong the credit quality is in this business. And of course, the environment itself has been very strong as well. So, so that has resulted in a really big repayment push, which is fine in a way, though it makes it harder to actually grow the AUM, but it is very strong signs from a credit risk standpoint. Let's move ahead. Granularity, we spoke about 70 crores is the average ticket size. If anything, it's going lower rather than higher. The average loan is about 3 years tenure. And if you look at a mix by ticket size, you can see that there are very few cases which are more than 200 crores. There are 7 cases between 200 and 500. There is nothing above 500. This for a company where the average ticket size used to be about 500 in the past, in the first go round when you saw us do wholesale lending. So it's a very, very different kind of business. You can also see diversification across industries in the donut on the left. Let's move ahead. I will skip this. Let's move ahead. The discontinued business, the legacy business, which has been coming down. Let's talk a little bit about that. You can see on the left chart here that the business used to be at peak about 51,000 crores. It has now come down to 6,900 crores. So we have brought it down very, very steeply over the last few years. The last 3 years, we've brought it down from 30 to 50% every year. The remaining bit that we do have, the 6,900 crores, we have about 730 crores of provisions against it. And we also expect a whole bunch of other gains through our AIFs, through more stake sales in the Shriram insurance businesses, etc. So we believe that we will continue to be net worth protected even as we bring down this 6,900 to 3,000 to 3,500 as we have guided in the past. Let's move ahead. This chart talks a little bit about the AUM that has happened so far, and how the left-hand side shows how to bring the AUM down over the last 3 years. We've taken almost 15,000 crores of provisions, which is a haircut of about 25%. However, the chart on the right says that in spite of taking 15,000 crores out of provisions, our net worth has remained protected. We started with a 30,000 crore net worth. We ended with a 27,000 crore net worth. And in fact, in the middle, you can see the 4,000 crores that we returned to shareholders in the form of dividends or a buyback. So effectively, our net worth has not changed at all. If anything, it has gone up over this 3-year period, in spite of taking 15,000 crores of provisions. Why did that happen? Because we had a lot of one-time gains that came in between, gains in the form of Shriram stake sales, in the form of DHFL acquisition, etc. And so over the last 3 years, the big transformation that I've told you about, we have been able to achieve that big transformation. We have been able to bring down the wholesale legacy book so significantly without impacting net worth even a little bit. In fact, net worth has gone up in this period. And that's precisely what we are guiding as well, that even the little bit that is left, the 6,000 odd crores that is left, for this to come down to 3,000 crores as well, we will have the same situation. Net worth will not get impacted. Net worth, if anything, will keep increasing of the company. You should not expect any net worth impairment because of legacy book rundown, as you have seen in the last 3 years. Let's move on. The chart in the middle shows the 90-day delinquency of the retail business quarter on quarter over the last 12 quarters. And the boxes all around show product level 90-day delinquencies over the same 12-month period. Just to make visual comparisons easy, we have kept the y-axis scale the same across all charts. So you can see that the 2 charts on top, housing and lab, are very low risk, and they're also very stable at about 50 basis points. The charts on the left, used car and salaried personal loans, are a little bit higher at about 100 basis points, but they are also stable. But you find the 2 charts on the right, digital loans is high and it's very volatile. And you will see that business loans was kind of moderate, but has been increasing. So the orange line used to be about 1%. It's now about 2.5%. So what you see in this chart is that different businesses have different risk characteristics. They have gone through different cycles. They are not all the same. However, because we have a multi-product strategy, what we have been able to do is to accelerate the right businesses at the right time and decelerate the right businesses to make sure that at the overall level, the chart in the middle has remained rock steady. It has actually not done anything at all. We have been able to change the mix of the businesses very deliberately and on a dynamic basis to make sure that even if individual businesses go do whatever up-down movement, our overall remains very stable. And that's been the power of having a multi-product retail strategy that we have built over the last 5 years. Let's move ahead. We can skip the next page. Yeah, let's go to profitability real quick. Yes, profitability. Let's start with the chart in the bottom middle, right? That is the PBT ROAUM. We made 1.4% of ROAUM last year. You will notice two things here. One is that there is this big gray box, which is called POSI recoveries. Let me just quickly explain what that is. When we purchased Divan Housing in 2021, we also got with it a big NPA book on the retail side of Divan, which we paid very little money for because it was NPA. But what we have actually been able to recover from that book has been significantly better than what we paid for it, and that delta has actually flowed into our ROA. And so the gray bar represents the incremental recoveries that we made over and above what we paid for Divan in these last couple of years. Now, this money, of course, we used for the legacy book reduction, etc., that I just spoke about, and that's why you saw no net worth reduction. But as you can imagine, that NPA book is now almost done. We have almost recovered everything that we were going to recover. So you should expect that gray bar to become zero over time. And so what remains is the dark blue box, where we made about 1.1% of ROA in the last financial year. But if you look specifically at Q4, we made 1.8% of ROA. Q4, of course, I will warn you, always tends to be seasonally a little bit strong from a profitability standpoint. So we did make much higher ROA in Q4 compared to the full year average. Full year average was about 1.4 for the full business, and we made 1.8 in the fourth quarter. You will also notice that OPEX has continued to come down from 5.6 to 5.1 to 4.2. We are guiding in the medium term for a return on AUM of 2.5 to 3%, which means over Q4 numbers, we need another 70 plus basis points, most of which will come through OPEX and a little bit through margin expansion, particularly as the RBI goes to a rate reduction regime. Let's move ahead. I talked about stability of profits. You see the chart on the right. This shows the consolidated profits over the last 3 years. And you can see that for the first 7-8 quarters, profit was extremely volatile. There was a big positive profit one quarter and a big negative profit the next quarter and a big positive again and negative again and so on. It was very volatile, very up and down. However, you can see that for the last 5 quarters, as the legacy book has become much smaller, you can see how the lot of stability has come. So the volatility has bottomed out. You have seen stability, which has been about 100, 150 crores of profits every quarter for the last 5 quarters. And now going forward for the next year, we have guided 1,300 to 1,500 crores over the next 4 quarters. So you can imagine more stable but higher bars in the coming 4 quarters. So profitability has really stabilized. Let's move ahead. On the liability side, a couple of pages that I will touch on. The chart on the top left, particularly the red line, which is the consol level capital adequacy. That's the line you should focus on because the other 2 lines, of course, as the company merges, those 2 lines will disappear. The consol level capital adequacy has been stable at about 24% throughout this entire period. Needless to say, meaningfully higher than RBI's required 15%. From a liquidity perspective, cash levels in the company as of March end, we had 10,100 crores of cash. Very, very high levels of cash for a book that's 80,000 crores, 10,000 crores of cash, upwards of 12% of the AUM held as cash. So very liquid right now. At this ratio, 10,000 crores on 80,000 crores, which is about 12.5% of cash to AUM. To our knowledge, it is the highest of any NBFC that's where listed information is available. So it's a very high level of liquidity to be carrying on our balance sheet. Let's move ahead. From an asset liability profile perspective, positive gaps everywhere, no problems. LCR on the right, again, a liquidity point. Our LCR requirement regulatorily is 100%. As you can see in the bars, the LCR we are actually carrying is well, insanely high. It's upwards of 1,000% actually as of March end. Even on a full quarter average basis for the fourth quarter, we had an LCR of 205%. So very high levels of liquidity, as I mentioned. Let's move ahead. We have been diversifying our borrowings. The two big areas which we have created in this last year are securitization and external commercial borrowings, which were kind of non-existent a year and a half ago, but today form about 20% of our borrowings between these two sources. We also got internationally rated by both S&P and Moody's. Let's move ahead. The final point on merger, the top co and bottom co, which is Piramal Enterprises, the listed company, merging into the unlisted company, Piramal Finance. That process is well underway. The big things we were waiting for were around RBI approvals, etc. All that came in April, and the NCLT process is now undergoing, and we expect the process to get completed by September. And so for a little while, you will see the stock being in a blackout period because the listed company is merging into the unlisted company. So Piramal Finance will become the listed company hopefully by the end of September. So that process is going as per schedule, and all the key approvals from regulatory bodies are now in. Let's go ahead, and I think we'll wrap up. Let's go ahead to the next page. So I'll finish where we started, which is the summary of the Piramal Finance story. So what did we speak about? Number one, very strong promoter group, demonstrated ability to raise equity and debt across cycles. Number two, a strong management team, proven track record of building businesses in other places. The transformation that has been going on is, over the last few years is now complete. We have now become, the growth AUM has now become 91% of total AUM. And as you can see in point number 4, retail is now 80% of total AUM. So we've become a retail-led NBFC, very diversified, very granular wholesale to book in there as well. Number 5, profitability has stabilized, and all the volatility that you used to see has not been there over the last year and a half, as the mix has shifted away from the legacy book to the growth book. After 2 years of negative profits, we moved to positive profits in FY25, and we are guiding to 2 to 3x profit growth in FY26. And finally, balance sheet very strong, very high levels of capital at about 24% capital adequacy, and very high levels of liquidity as well. So that's the story. I hope you enjoyed listening to that, and I hope that made sense. I hand it over back to you, Vishal, for Q&A from the audience.
Thank you, Mr. Jairam. Pretty fascinating. I think personally, in my previous avatar, I was very involved with Piramal, especially during the acquisition time of Divan Housing, and quite a stunning turnaround, I must say, or transformation. We do have some audience live questions and some questions sent earlier. So let's jump straight into it. In case of macroeconomic slowdown, what sectors in your loan book would be most vulnerable? Now, I did see some spikes happening on the personal loan and business loan side, but how do you envisage? We're seeing especially in the MFI and other PL section, a bit of a slowdown coming.
Yeah. So the last, I would say 9 months or so, you've seen us slowing down materially in 2 areas: digital lending and business loans, which is unsecured lending to small businesses. That's where we have seen the most impact. Let's see how that continues to play out. There are, within business loans as well, there are particular sectors where we're seeing some challenges. In particular, for example, among MSMEs, the retail sector is one where we are seeing some challenges. The mom and pop stores, the kirana stores, we are seeing some challenges there, particularly with the rise of quick commerce. Yes. There is some challenge that's emerging in that sector. So that's an area we are cautious about. Food and beverages is the other area. So kind of single unit restaurants, etc. We are seeing some challenges there. Textiles, a little bit of challenge there. So those are some of the sectors where we are seeing some issues. Geographically, South has been actually very good, but but these things tend to change product by product. So, for example, when Karnataka moved to e-registration of properties, we saw 3-4 months of significant slowdown in Karnataka. But now that has come back up. These things change time to time. But we don't have any big macro policy. One of the things I often say is that I'm not a massive believer in decision making based on macro, because nobody understands macro. I certainly don't, so making any choices of big portfolio decisions on that basis is, I think, a little bit foolhardy. What we'd much rather do is just look at our data very, very closely on a regular basis, daily basis, and react to whatever data is coming ahead. Or to use a cricketing analogy, play the ball that you're facing. Don't overthink it. And so we try to look at every ball as it comes and try to face that ball. So you will not hear me give big macro gyan on where the world is headed.
No, fair enough. Thank you. I think you touched upon the promoters' individual shareholding. Post the merger, what would be the promoters' current shareholding of the two merged financial services entities, and also question of there's any disclosure or any pledging of these ownership?
Yeah, so the portfolio, the holding is not going to change. It's going to remain 46%, I think, is where it is right now. I think in the merged entity as well, promoters are going to hold 46%. The promoters, just to be clear, have increased shareholding over the last 4 or 5 years. They've never decreased. They've not sold at all. Even when we did a pref allotment issue, etc. as well, they did not participate. Rights issue, they did not participate. And so promoter shareholding has, if anything, continued to go up in this period. From your second question on pledge, I don't know whether we have specific disclosures on the pledge. We don't have specific disclosures on the pledge that we have made. There is nothing to mention there. As you can imagine, the company has done very well over these last couple of years. I can informally just state that, without getting into numbers, that whatever might have been pledge situations, etc., would be almost non-existent, or would have significantly reduced in this period, given how the company has done.
Fair enough. Obviously, a bunch of bond investors. So the current debt equity and gearing, we saw a little tick up in the numbers that you presented in the last 4 quarters. What is the expected leverage that you're optimizing for in FY26?
Yeah. See, we are a very low leverage company, Vishal. We can obviously not run a financial services company with 2.5x leverage, which is where we are right now. What we have said is that our threshold is probably going to be about 4x debt to equity, or 5x assets to equity, and that we'll keep gearing till that point, and at that point we will go and raise equity again.
And sorry, just to segue and maintain the credit rating, you have a very solid AA credit rating. So there is no plan to, as you accelerate on your leverage, to live with a low credit rating as such.
No. If anything, the credit rating is an upward bias, given the transformation that has happened in the company. We used to be a AA plus company 5 years ago. And when the company got into trouble by that real estate lending, we got downgraded from AA plus to AA, which is where we have been for the last 5 years. As you've seen the story has transformed completely, and we are making our case with the rating agencies to look at us constructively for an upward move. But of course, it's their call. It's not. It's nothing.
I think you spoke about the legacy size of the book, but what about the DHFL portfolio? In terms of numbers or percentages, if you can give us an idea of what's remaining.
Very little. The overall DHFL retail, but the wholesale book, almost nothing remains. Only about 200-300 crores remains. We had anyway written down the wholesale book almost to zero. Like we took almost a 95% haircut on the wholesale book the moment we bought it, because much of it was fraudulent, as you know. So we brought it on book only at about 2,500 crores or so. That is now down to about 200-300 crores. The retail book we brought in at about, it was about a 20,000 crore book. We brought in at about 18 or 19,000 crores. That number is now down to below 10,000 crores. So of the 80,000 crore book, the old Divan book is a little under 10,000 crores.
Yeah, that's great. A question which has appeared twice. What is the spread of NIM in retail versus wholesale that you operate at?
Very similar. Retail's, overall fee plus, yield, or just yield retail is going to be about 13.5%, and then there's about 1% of or 1.25% of fees and other income that's there, and we have a cost of funds of about 7%, so that makes a margin of about 7%, which is very similar between retail and wholesale.
Comment, appreciate the turnaround story, which we know future plans. I know you touched upon from a quantitative point of view, but any two key highlights
See, I
for your
think
FY?
we will we have guided that we will grow to be about a 2x of our current size in the next 3 years. So about 1.5 lakh crores of book, and maybe get a 3,000 plus crores of profits. Annualized at that time, we have guided to 13 to 1,500 for next year. So making solid progress on the risk front as well. From a business standpoint, we'll continue to remain at roughly, let's say, 85% retail business. We are there in most of the product categories and business categories that we want to be in. A couple of products that we are not big in that we would like to invest more. We continue to like, in spite of all recent challenges, we continue to like the microfinance business, and you'll probably see us invest more and actually get a little bit bigger. And we don't have a gold loans business, which we do want to build. So that's one new area that you will probably see us entering in the next year or so.
Yeah, you did speak about your cost of funds. Another question has come, what is the cost of funds? I think it's pretty stable around 9%.
Cost of borrowing is 9%, cost of funds is 7%, correct?
7%, sorry. So what is your interest servicing bill for the year as such?
We have a total borrowing of about 62,000 crores, and our cost is about 9%, so you can just do the math.
No, fair enough. This slight inch up in gross NPA to 2.8%, up from 2.4. Anything which
No,
which
nothing to note there. You will see a little bit of this tick up, kind of go up and down. We don't try to micromanage this number. You saw the overall. What we like to track much more is not the accounting metric, but actually the operating metric, which is the delinquency ratios, which have been very, very stable. So we have no problems there. I think you'll see this number kind of moderate. The accounting GNPA number does tend to depend a lot on whether you do settlement of particular accounts which had higher provisions on it, and those types of things. And if you do a settlement, the account goes away from your NPA pool, so everything comes down. If you don't do a settlement, it stays in, so GNPA ratio looks higher. These are operating choices. They don't say anything about the asset quality of the book, so I don't tend to look at that metric as closely as the operating metric of delinquency, where you have seen the stability that we have shown. So I wouldn't worry about it much.
Last couple of questions from our guys. So people, please feel free to type in your questions. From a liquidity point of view, you have 10,000 crores in liquid instruments that you spoke, and you said that's a large number. Do you plan to change that, or why are you holding so much cash in liquid instruments?
That's a good question. We actually don't want to hold that much cash. Honestly, it's too much. But March was also a little bit. Sometimes these things happen in quarter ends. You end up, big loan facility ends up fructifying, so you end up taking the money, even though you don't have any immediate use for it. Some of that money we have used to prepay and do some, take care of some other loans in April and May. Our intent is going to be to actually be a little bit lower than this 10,000 number, maybe closer to 8,000 is where we would like to steadily be. Otherwise, the negative carry is too much. Though from a lender's perspective, I get this question a lot more in the equity conversations, where people are always worried that why you're carrying so much cash. From a lender's perspective, this probably is great news for you all that that we have so much cash and liquidity, and we don't have any short-term anxieties to kind of worry about. But yes, the equity guys do tend to worry about it, that we are paying negative carry on a large amount, and I do want to bring it down a little bit. We will always be conservative. And we don't want to get too close to the edge of what we need. So we'll probably always have a little bit more in the bank than we need. But probably right now the fridge is over full. So I'll probably have to eat a little and reduce the quantity in the fridge.
Yeah. Just to make it clear for all the audience, because there are different ways of asking the same question. What is the proportion of the legacy Divan book as compared to your total AUM? I want to put that to rest and let people know. So if you could just answer that question.
See, the legacy Divan book, if you're looking at the wholesale part or the problematic part of Divan book, there is nothing. There is no book left at all. The 6,900 crores of legacy book that is there is all old Piramal legacy. It is not Divan legacy. There's very, very tiny amount of Divan legacy there. It's ignorable. It's too small. Yes. So Divan, you can forget about Divan for now. Like, I think that story is over. Both on the positive side and on the negative side. You saw the positive side, the POCI, the big ROA boost that came. That story is also over. All the legacy related costs and hits that were there on Divan, that story is also over. Both those stories are over. Divan is pretty much fully digested. There is no further Divan story to look at.
No, perfect. I think that brings us to the end of Q&A, Mr. Jairam. Thank you so much for our audience. There is a merger happening. You will hear from the company going forward on consent as bond investors. You heard the story from the company itself. Very strong and transformation turnaround. Thank you for being with us, Mr. Sridharan. A pleasure hosting you and hearing the Piramal story. Wish you guys all the best for FY26. And again, once again, thank you from the bond investors.
Thank you, Vishal, and thanks to everybody for joining us on the call.
Thank you.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.